Hello and welcome to DealPen's video series on analyzing the capital markets. This is our fourth installment, and if you've seen our other video casts or this is your first one, welcome back, and thank you for joining us. Keep the comments coming in. We greatly appreciate any feedback that you have on these video series. Today's video series, we will be talking about valuations and what we are currently seeing in the marketplace. This topic is one that we will be touching upon consistently because every few weeks we can be doing an update on what we're seeing in the marketplace in terms of valuations. This is always a very fluid subject. And valuations can touch on a number of points, whether it's in the public marketplace, whether it's in the world of private equity and valuing liquid securities or takeouts of entire entities. Valuations today are very interesting from a couple of standpoints. First, let's talk about in the public markets. It would appear to me that most people in the markets, the public markets, stock markets, feel like valuations are pretty attractive. But the interesting thing is that two things are happening out there. Number one, you are seeing a lot of growth in the larger cap companies, and you're seeing still not a lot of pickup in the more liquid and smaller cap securities. However, the point I want to make here is that there's this dichotomy happening within the marketplace of how some securities are starting to get a pickup in their valuations, and how there's a pack of companies that are not. And it's to my second point that I see this happening because there are a lot of participants in the marketplace that are making bets that there is going to be huge inflation coming in the United States because of quantitative easing part 2, or famously being called today as QE2, which, as we know, the Fed and Bernanke and everybody and President Obama is working very hard to defend. And as of today, as this publishing this video, it's pretty questionable on their ability to defend QE2. So we're living history real time here to see how the continuation of quantitative easing is going to affect not only the markets in the United States but across the world. In my personal opinion, I think the reason that the United States has the opportunity to get away with this, as PIMCO, as an author, as a portfolio manager at PIMCO called it, this is a legal Ponzi scheme going on. And if you really look at what printing money is all about, there's some reality in it. But the United States is able to do this in today's environment because there's global pressures to kickstart the global economy. And so everybody is having to take these drastic measures to get everything back on a growth track. And it's hard to argue with it because the inverse of that situation is pretty dicey and scary too. But not to get on that subject, we're talking about valuations. But the reality is everything that's going on with the decisions of the Fed and the Treasury today is really driving and government decisions, because taxes are playing a big part of this too. So the broader influence of not only the government, the United States government, but governments throughout the world are really driving valuations, which is no surprise because investors are scrambling to make bets on how all of these decisions, which will no doubt are having and will have significant impacts on our financial markets, and people are making that hopefully educated bet on how this is going to pan out. So the point being is that there's, in the public markets, there are sectors of the marketplace that are experiencing differences in their changes in valuations. But overall, with the larger cap companies and the broader markets in general, we've seen a nice uptick in the S&P 500 and the Dow and so forth. And that is happening in all likelihood because institutional money in particular is making a bet that the equity markets are going to continue to rise as we continue to have to conduct broader quantitative easing. The second point I'd like to touch upon in terms of valuations, and probably what a little more of our audience cares about, is valuations in the private company marketplace. It is extremely interesting out there. Any companies that do not have robust cash flow or have negative cash flow or are pre-revenue, the valuations are extremely difficult unless you are talking about some of the more interesting opportunities around always in the tech space. Some of the tech companies continue to drive pretty hefty valuations, but a lot of times they are outliers because they're experiencing phenomenal growth, like Facebook and LinkedIn and a lot of these social media sites that we're using today. But when it boils down to the mainstay private companies in the United States, you are either seeing companies that are getting away with some of the all-time high in valuations, and you're seeing some companies that just have a complete inability to raise capital or to get transactions done because their capital structure is probably a little bit too broken to fix. The private equity players today are having a very interesting time because they are in a situation where the bidding going on for companies that have strong cash flow characteristics and are doing fairly well, those companies are going for high multiples, if not in some cases all-time high multiples. You're talking about multiples, 7, 8 times EBITDA, even into the teens for the right opportunities. And there's quite a bidding war that is happening in the background for some other reasons I'm going to touch upon in a minute. But these multiples in the private equity world are much higher than they've traditionally been, which is 3, 4, 5 times EBITDA, which is much more in line with the business model of private equity, where they can go in and put a leverage on the situation, put debt financing in a situation, and where it can ensure a model where they've mitigated as much risk as they can in terms of valuations and potential returns, and then they can go and continue to work with these entities and all their portfolio holding companies to build them, and not only to continue to get the cash flow that these entities have generated in the past, but to also to build them into, lack of better terms, sexier organizations where, on the exit they can command, a higher multiple from when the investor entered the situation. On touching upon that bidding situation that I had mentioned, the reason that is happening is twofold. One, the private equity firms are getting into a situation where they have to deploy capital. The thing you have to remember about private equity firms is that their funds, when they say they've got a $100 million fund, that is only a commitment. That's not money that is necessarily sitting in a bank account for them that they're collecting fees on. That is committed capital that they have the ability to go out and make acquisitions. And as they make those acquisitions and deploy that capital, at that point in time, the private equity funds can charge their traditional management fees, which is what they live on as an organization. Many of the private equity funds are getting to a point where they're at the end of their investing life cycle. And if they don't, in this example, $100 million, if they only deploy 50 million of it and their time period of their investment pool is coming to an end, they have to return that other 50 million. And that's a $50 million they're never going to be able to charge management fees on. And so the incentives in the private, you have to keep in mind the incentives in the private equity world. They want to deploy that capital so they can charge fees and they can go and build these organizations, build the returns for their investors, and so then they can go do it again and get a bigger fund and build more. on the management fee side. So once again, that's why you're seeing some interesting situations and bidding wars breaking out in a global recession for good organizations. They're getting some very high multiples right now because private equity funds have been in a situation where they haven't been able to deploy capital as people pulled in reins in 2008, 2009, and they're getting to a point where they have to deploy capital. And the other piece of the equation for private equity funds is that they are having a hard time finding quality companies in which to bid on and that can fit. And so the good ones that are out there, that's why there's more people being brought to the table. They're not able to get deals directly done. It's typically several people coming to the table. So good opportunities for some of the right private businesses that are looking to exit. The other thing I wanted to touch upon that's also driving a bit of a frenzy as we go into year end, there's always a bit of a year end frenzy that can, if you're selling your company, thinking about year end stuff is always a good time because there's a bit of a frenzy to get things done at the end, which can also help get valuations up a little bit. But we have an interesting situation that's currently unfolding because of the government and going back to the government and to taxes. There is a question mark out there, and I'm not a tax expert, but there's question marks out there on the Bush tax cuts and what may come to bear in terms of capital gains and so forth. And so a lot of people wanted to get everything done by the end of the year because they know what they're dealing with in terms of the current tax regime, which is going to change. If it doesn't change in 2011, it's bound to change. It always does, is the reality. The government's always tweaking things. So if you're a private business owner, that's a good thing to keep in mind because your potential buyers, especially when you're dealing with private equity, you need to look at what they have available to deploy, create a bit of a feeding frenzy, and on top of it, also think about the current tax regimes. So we touched upon, to recap, we touched upon valuations in the public market space. We touched upon valuations in the private market space with the punchline that valuations are always very dynamic and you need to keep a pulse on it yourself, what you're doing within your industry, in your competitors, and what your own long-term outlook looks like is typically the biggest driver of valuation. You can only pull so much data from the broader markets to make assumptions on what your enterprise is really worth. You have to boil it down to your organization and what you're doing. That concludes our video series on discussing trends and valuations, and we'll continue to earmark these video podcasts to what topics we're discussing. So continue to watch in the future on valuation updates because I'm sure we will have plenty of them as we continue. Thank you for watching, and as always, we look forward to getting your feedback and comments. Thank you.